In today's video, we are going to walk through how our company would set up your whole life insurance policy for maximum cash value. What we'll look at is a case study based on an individual who recently reached out to our office, and they were somewhat new to whole life insurance. They're interested in the cash value for the core benefits, safety, liquidity, and the tax-free piece as well. But they really wanted some guidance with respect to how to set up the policy. We had our recommendation, but then at the same time, they have what they're comfortable doing with respect to getting money into the policy. So we'll walk through exactly how we set it up. We'll go through a couple different companies as well. And hopefully this helps in terms of providing information and helping you decide what company and product is best for you if you're interested in a whole life insurance policy for maximum cash value. So we've got a 55-year-old individual. It's a 55-year-old female in this video. What company to choose? She's been researching whole life insurance for a bit now. When it comes to company selection, we always recommend one of the four major mutual companies. The simple reason is because we've seen the strongest cash value performance in whole life insurance products with those companies compared to everyone else. I'm talking about actual performance, not what we see on the illustration, but real results. We've received proof of performance from those four major mutuals. So what we're going to look at today are products with Mass Mutual and Guardian. Now in her situation, she has a lump sum of about $300,000, but she's not comfortable starting with the full amount, meaning she does not want to start a policy with a lump sum of 300 grand immediately. If she did, we gravitate toward Guardian because they do allow large lump sums in the first year where we can exceed the standard limits that they have in a policy. I'll explain exactly what that means in a minute, but she's not comfortable with that. What she's comfortable with from a funding standpoint is as follows. She'd like to fund her policy with $100,000 per year for 3 years, and then just the minimum, which is about $10,000 per year thereafter through year 10. She wants the option to add more than this, but that's all she wants to add. She's very comfortable with that. She said, show me what this looks like. That's where I'd like to start. If I can add more, that's great. We can look at those numbers, but this is something I know I can do. So let's see what the numbers look like based on my numbers and what I know I can get into the policy. So how would we set it up? We're going to look at the actual illustrations, but let me walk you through this first because this is the most important piece. Both Mass Mutual and Guardian, when you look at their limits, they're very similar. So if you're funding $100,000 per year for 3 years, your money can go toward one of two main areas. We've got the minimum premium, which you'll see in small print here is the base premium plus the term insurance rider. And then we have our PUA rider, which stands for paid up additions. I like to call this a cash dump-in. And you'll see here, this is flexible. It's not required to go in. This is the key to maximizing the cash value growth in a life insurance policy. So if you put $1 here, let's do it this way, into the premium piece, your cash value will be about 0 in the first year, sometimes the first and second year. Whereas if you put $1 down here into the PUA piece, you'll see the cash value there. It's going to be between 90 and 95% in the first year. Companies do have fees because PUAs get you a small amount of death benefit. Premium dollars get you a large amount of death benefit. But this is how you maximize the cash value growth in a policy. 90 to 95% of it shows up in cash value in the first year, and it begins compounding. And this is how we really see a gain in our policy early. You're going to see the illustrations in a minute. I'm going to go through the exact scenarios we prepared for her. So, knowing what we just went through there, if you can put $1 into either of those areas and you're interested in cash value, where would you want to put all of your dollars? To the premium or to the PUA rider? The PUA rider. Most people ask, what's the maximum I can put there? Years ago, when I was first learning all of this, remember one day I'm playing around with the illustration software on my couch when I still lived at home, and my dad goes, can I just put everything into the PUA rider? Like, no, we can't do that. Insurance companies do require that we put something into the premium piece as well. My response at the time was, no, you can't do that, because that's all I knew. But anyway, how much can we put into the PUA rider, or what are the limits? That's really the key here. You'll see both MassMutual and Guardian will allow about a 10% minimum premium. See, it's a little bit less sometimes. For example, Guardian, we can squeeze it down to about 9.1%, but for the sake of simplicity, we'll say 10% minimum, a minimum premium, and then the 90% of our funding going toward PUAs. So if you've got 100 grand going in, 10% of 100,000 is what? $10,000. Then your PUA rider would be what? $90,000. Flexible, not required. What a lot of people we work with do is set up a policy where they're only billed for this. So every year when their premium comes due, if this is you, you would pay just this, and then everything else, you could just add at your leisure, because you're not required to add funds into PUAs. This prevents someone from feeling like, I have to fund the policy according to plan. I have to get 100K in every year. Even people that know they can do that no problem, I found still like this flexibility because it just makes it easier to work with. Convenience is key. So from a setup standpoint, we've got a $10,000 minimum, approximate. You'll see the exact minimums for her. The MEC limit, which is that taxable line on a life insurance policy, is 100K. How we set this is with the total amount of life insurance. So without getting into the weeds, what I'll say is the total death benefit is at the minimum number possible to reduce costs and maximize cash value without triggering a MEC, which would result in taxation. So with these two companies, let's go through some of the differences. Actually, the flexibility piece, an important item. MassMutual requires that I pay the premium plus the PUA at the same time. So before where I mentioned can commit to the minimum and add PUAs at leisure, you can do that with Guardian. With Mass, we can adjust this, but the flexibility comes into play one time per year. So when the insurance company bills you the premium, at that point in time, we can scale the PUA up and down. And if we do it on the premium due date, there's no medical underwriting involved there. So that's the key as far as how we keep it convenient. We do have some videos that provide a thorough breakdown on the flexibility. So let's take a look at the numbers. First, we've got the illustrations. I'm not going to go through these because they're like stereo instructions. What I'll hit on very quickly is just what we covered on the whiteboard. Money can go where? For the premium or the PUA. Here's your premium. We've also got the term rider. True minimum commitment are those two combined. So just over $11,500 per year. Whereas with Guardian, there's your premium. There's your cost of term. The minimum are those two combined. So call it 10.8. We can actually get the minimum, the net, right around to 10 in this example too. But that's where we've got everything to start. Okay, so let us have some fun. We'll begin with the MassMutual illustration we just had up. What do we see here? There's the funding. Minimum, $11,150. But she's funding $100K per year for 3 years. What she's interested in is the cash value. First year, 89%. Keep in mind, she's starting at 55 years old. Death benefit, $1.16 million. Oddball number, that gives her a MEC limit of $100,000. It's a minimum death benefit we could attain based on that 100K she wants to add every year. Cash value growth. Do you know why that's negative $10,800 in the first year? Take your first year payment. Look at your first year cash value, $89,184. Subtract those two from each other. You'll get this. That's your loss in the first year. What doesn't show up in cash value, or takes the biggest bite out of your cash value initially? The premium piece. Year two, you had another 100K. You were at 89. Now it's 185. If you just add 100 to 189, what would you have? 189. You have less than that. That's why you have a loss. You're getting less back than what you're paying in. How about the next year? Throw in 100. 185 to 289. So you got the full 100 back. That would bring you to 285 plus another $4,000 in change. This represents what you're getting from the insurance company, the net growth. What drives me nuts sometimes is when we see on an illustration or someone explains that, hey, look, you're at $185,000 and your cash value is $289,000. So your growth was $104,000 and change. Year three, it's like, no, I paid $100,000. So if you pay $100,000 of your own money, yes, it's contributing to the policy's value, but that's not the growth you're receiving from the insurance company. No, we want the net dollar amount we're getting from them. Let's back out our payments. What's highlighted here in year four, that's the first year you get your money back or your break-even point. And then it's positive from that point forward. Okay. Let's look at Guardian. We've got two different Guardian options, 10% PUA fee and 5% PUA fee. The 10% gives you a bit more long-term, where the 5% gives you more upfront. You'll see that in a minute. So minimum, initially, $10,800. I've actually got to correct this because we paid just the base beginning year four. If we go back to that illustration, you'll see it was just 10K, which is why the outlay is 10,000, but I'll correct that in a minute. The illustration shows 10. That's my error there where I plugged in 10.8. So break-even point here, year five with this option. So a little bit delayed compared to the Mass Mutual option. More of a hit up front. We see the growth picking up the pace as the years pass. So why, if she was just between these two options, why might she choose this option? I'll let you know why some people choose this option when they're comparing the two side by side. One, when we look at Mass and Guardian and New York Life and Northwestern Mutual, they all show illustrations like what we see here, displaying stronger numbers than each other at one point in time. It usually depends on what company has the highest dividend when the illustrations are run. In reality, we've seen them all deliver somewhat comparable results in terms of real performance. So when someone sees that and hears that, they say, okay, long-term, they should be somewhat equal. Okay, that's one check mark to say the illustration with the lesser values long-term, it might be a little bit closer than what it illustrates. The other big reason comes into the flexibility. So with this company, she can set it up where she's billed for the minimum only. So if this is you, all you have to pay is the 10.8, and then everything above that can be added at your discretion. You don't even have to. So if you wanted more flexibility and not feel like you're forced to add the 100K all up front at the beginning of each year, Guardian's nice for that. Whereas Mass got a similar setup with the minimum and the total amount. However, we've got to fund the full 100 each year. If you said year two, I don't want to fund 100, what we could do is scale it down to 50. But if you wanted to increase it again, we'd have to wait until year three. So it's when the premium comes due is when we can adjust the total dollar amount very easily. With Guardian, it's a bit more flexible. Some people like that. Some people don't care. Depends on your situation. Then we've got the 5% PUA fee. What do you notice there? More value up front. This is the only option or only product we see here that shows positive cash value growth in year 2 when we look at it. You're at 1860 in that example to the far right. So you got more up front. By year 10, you can see the other Guardian option, the 10% PUA fee, is providing more. But it's an option. We've seen people go back and forth with these two, which is why we always show them both. If you like the stronger guarantees, we'll see it with this option. Pardon my poor penmanship. And then we can look at them long-term too. I'm going to go all the way down. But how we would set the policy up in both cases is with minimum premiums, and the simple reason why is we've seen the strongest actual results there, strongest actual cash values, not just good-looking projections or something like that. So we go through the different options, explain the flexibility, present them, and then really ask which option, if any, do you prefer? Or would you like to see additional companies? Or do you feel that it's just not a fit for you, which is perfectly fine? Really, we just want to make sure the individual understands the options that are presented of the most popular ones based on their situation, and then selects the one they're most comfortable with. Then we walk through next steps as far as how they can start a policy, how it works as the years pass. When I say works, like how it actually works as far as your online portal, getting money in, requesting loans, how we're always in touch with you as the years pass, all the fun stuff that happens afterwards. So I hope you enjoyed this video. Please let us know your thoughts. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.